Investing in undervalued stocks can be a great way to generate significant returns, but there are some common mistakes that you need to be aware of. You'll see higher profits if you avoid these mistakes while investing in undervalued stocks. Hello everyone and welcome to Omega Finance's YouTube channel. Do you have losses even after picking the right undervalued stocks? The answer is to examine your investment process carefully. There are some mistakes that most investors make while investing in undervalued stocks. Don't worry. In this video, we'll cover all those mistakes and tell you why investors make these mistakes. All you will know if you watch this video till the end without skipping it. So sit back, relax, and get ready to learn about the mistakes while investing in undervalued stocks. Let's get started. There are some common mistakes that investors should avoid. Here are a few of them. Failing to do adequate research. Many investors make the mistake of not doing enough research before investing in undervalued stocks. Understanding the company's financials, management, and industry trends is important before making an investment decision. Let me give you an example of an Indian undervalued stock to illustrate this point. In 2019, the Indian automobile industry was facing a slowdown due to various factors, including a liquidity crunch and a slowdown in the economy. This significantly impacted the stock prices of automobile companies in India, including Mahindra and Mahindra Limited, or M&M. M&M is a leading automobile company in India that manufactures many vehicles, including SUVs, commercial vehicles, and electric cars. The company's stock price had fallen significantly due to the slowdown in the industry, and it was trading at an attractive valuation compared to its peers. However, investors who failed to do adequate research before investing in M&M would have missed some critical factors that could impact the company's future growth prospects. For instance, the company was facing increasing competition from new players in the electric vehicle segment, and it was struggling to gain market share in this rapidly growing market. Additionally, M&M had significant exposure to the rural market, facing its own challenges, including a decline in farm incomes and rural demand. This could impact the company's sales and revenue growth in the future. Investors who did not consider these factors and only looked at the company's undervalued stock price could have ended up with a subpar investment. On the other hand, investors who did their due diligence and understood the company's fundamentals and growth prospects would have been able to make a more informed investment decision. Focusing too much on the stock price. Investors often get attracted to undervalued stocks because of their low prices. However, the stock price alone is not a reliable indicator of the company's value. It is important to evaluate the company's fundamentals and future growth potential. Let me give you an example of an Indian undervalued stock to illustrate this point. In 2020, the Indian banking sector was going through a challenging phase due to the economic slowdown and the impact of the COVID-19 pandemic. One of the undervalued stocks in this sector was Yes Bank Limited. Yes Bank is a private sector bank in India that faced many challenges at the time. The bank's stock price had fallen significantly and it was trading at a very attractive valuation compared to its peers. This led many investors to believe that the stock was undervalued and presented an excellent investment opportunity. However, investors who only focused on the stock price and did not consider other factors such as the company's financials, management, and business model would have missed some critical red flags. Yes Bank faced several issues related to corporate governance, bad loans, and regulatory compliance. The bank had also been placed under a moratorium by the Reserve Bank of India, which limited its operations and led to significant uncertainty regarding its future prospects. Investors who only focused on the low stock price and did not consider these factors would have ended up with a suboptimal investment. On the other hand, investors who did their due diligence and evaluated the company's fundamentals and business prospects would have been able to make a more informed investment decision. Investing without a clear strategy. Investing in undervalued stocks without a clear strategy can lead to poor investment decisions. Having a clear investment plan, including entry and exit points, risk management, and diversification. Let me give you an example of an Indian undervalued stock to illustrate this point. In 2018, the Indian telecom sector was going through a challenging phase due to intense competition, rising debt levels, and regulatory headwinds. One of the undervalued stocks in this sector was Reliance Communications Limited, or RCom. RCom was a leading leading telecom company in India that was facing significant challenges at the time. The company's stock price had fallen sharply, and it was trading at a very attractive valuation compared to its peers. This led many investors to believe that the stock was undervalued and presented an excellent investment opportunity. However, some investors who invested in Arcom did so without a clear investment strategy. They did not have a clear plan on when to buy or sell the stock, how much to invest, and how to manage their risk. As a result, when the company's financial situation continued to deteriorate and it eventually filed for bankruptcy, these investors were caught off guard. They had not anticipated the company's eventual bankruptcy and had not factored it into their investment strategy. On the other hand, investors who had a clear investment strategy and a well-defined risk management plan would have been able to avoid losses. They would have anticipated the risks involved with investing in an undervalued stock like Arcom and would have taken steps to manage their risk. After having an idea of these mistakes, let's now discuss some more important mistakes that investors make. Before we move to the important mistakes, make sure to hit the thumbs up icon below to like this video. Stop loss contract. A stop loss contract is a risk management tool that investors can use to limit their potential losses. An order is placed with the broker or trading platform to sell a security when it reaches a particular price level. One example of a trading platform that offers stop-loss contracts is Zerodha, one of India's leading online brokers. Zerodha's trading app provides its users with an advanced order type called a stop-loss order. With this order type, traders can place an order to buy or sell a security at a specific price, which is the stop-loss trigger price. The stop-loss trigger price is when the stop-loss order becomes active and is executed in the market. Zerodha's stop-loss order type also includes a feature called trailing stop-loss, which is a variation of a standard stop-loss order. This feature adjusts the stop-loss trigger price automatically as the market price moves in the investor's favor. This allows investors to lock in profits and limit losses in a dynamic market. To use the stop-loss order feature on the Zerodha trading app, investors need to log in to their accounts and select the stock they want to trade. They can select the stop-loss order type and enter the stop-loss trigger price and the number of shares they want to trade. The app will execute the trade automatically when the stop-loss trigger price is reached. Zerodha's trading app provides investors with a user-friendly platform to use stop-loss contracts to manage their risk. By using this risk management tool, investors can limit their potential losses and make more informed investment decisions. Ignoring the risks. Investing in undervalued stocks can be risky. It is important to understand the risks associated with investing in undervalued stocks, such as company-specific, industry, and macroeconomic risks. Let me give you an example of an Indian undervalued stock to illustrate this point. In 2015, the Indian pharmaceutical sector was going through a phase of uncertainty due to regulatory changes in the US market, which is a crucial market for Indian pharmaceutical companies. One of the undervalued stocks in this sector was Sun Pharmaceutical Industries. Sun Pharma, a leading pharmaceutical company in India that was trading at a very attractive valuation compared to its peers. Many investors believed the company's low valuation made it an excellent investment opportunity. However, investors who ignored the risks associated with investing in Sun Pharma would have missed some critical red flags. The company faced several issues related to corporate governance, regulatory compliance, and quality control. In 2016, the US Food and Drug Administration, or FDA, issued a warning letter to Sun Pharma's manufacturing facility, which raised concerns about the company's quality control and compliance practices. This led to a significant decline in the company's stock price, and many investors who had invested in the stock without considering these risks suffered losses. On the other hand, investors who had factored in the risks associated with investing in Sun Pharma and had done their due diligence would have been better prepared to manage their risk. They would have anticipated the potential risks associated with investing in an undervalued stock in a sector facing regulatory changes and would have taken steps to manage their risk. Failing to be patient. Failing to be patient is another common mistake that investors make when investing in undervalued stocks. Many investors expect immediate returns on their investment, but undervalued stocks may take some time to realize their full potential. Let me give you an example of an Indian undervalued stock to illustrate this point. In 2013, the State Bank of India, or SBI, the largest public sector bank in India, was trading at a very attractive valuation compared to its peers. Many investors believed that the bank's low valuation made it an excellent investment opportunity. However, investors who were not patient enough to wait for the stock to appreciate missed out on the opportunity to make significant returns. SBI's stock price was undervalued due to concerns about the bank's asset quality and the slow growth of the Indian economy. However, the bank's management was taking steps to address these issues, such as tightening credit policies and improving the recovery of bad loans. These steps were expected to improve the bank's financial performance over time. Investors who were patient and held on to their SBI shares over the next few years were rewarded for their patience. The bank's financial performance improved significantly, and its stock price appreciated by over 200% between 2013 and 2017. On the other hand, investors who were not patient enough to wait for the stock to appreciate may have sold their shares at a loss, missing out on the opportunity to make significant returns. The process of investing is fraught with chances for mistakes. You will succeed more as an investor if you're aware of these mistakes, recognize when you're making one, and take steps to correct your direction. To avoid making the mistakes discussed in this video, it's important to create a systematic strategy and adhere to it. If you stick to these suggestions, you should be able to construct a portfolio that will bring you great long-term success. Remember, investing in the stock market requires patience, discipline, and a long-term perspective. Are you still making such mistakes while investing in undervalued stocks? Tell us in the comment section below. We have also uploaded a video on the 5 best dividend stocks in India with high growth rates on our channel, which can be very helpful to you while investing in dividend funds in 2023 and beyond. You can find the link to that video in the description below and in the card. Thank you for watching Omega Finance, and we'll see you in the next video.